Hello, and a very warm welcome to our new video series, Baatein, Bazaar and Beyond. In this series, we aim to bridge the gap between you and the professionals steering your investments at JM Financial Mutual Fund. An individual is shaped by multiple influences: his education, personal experiences, family background, philosophical influences, and experiences at work. These together shape the philosophy, work ethic, and decision making of an individual. In this series, we endeavor to get you a peek into such influences for our fund managers. We seek to know the person behind the profession. We start the series with the CIO at JM Financial Mutual Fund, Mr. Satish Ramanathan. He needs no introduction. He's been associated with the investment management industry for more than 3 decades, during which he has worked with asset management companies such as Franklin Templeton India Mutual Fund and Sundaram Mutual Fund. Prior to joining the JM Financial Mutual Fund, he had an entrepreneurial stint through Tattva Capital. So without further ado, let's move on with the show and welcome our first guest for this series, Mr. Satish Ramanathan.
Thank you for joining us, sir. Sir, you've been associated with the asset management industry for a period greater than 3 decades now. So what got you started? What was your initial motivation?
So I finished my engineering in '89, and at that point in time I felt that hardcore engineering wasn't for me, and I got captivated by reading a few annual reports, and then that motivated me to do my MBA. I completed that in Texas A&M, and I felt I would be more at home in India than anywhere else, and therefore I came back to India, and from there I've worked across credit rating, across consultancy, across several companies, and I found that my calling was finally equities, and that's been motivating me and driving me for the better part of 30 years.
During your formative years, sir, who or what were your main influences?
Apart from my family, where I would owe a lot of my initial formation due to my grandfather, who was also in the market briefly.
Oh, wonderful.
And then to my father as well. And after that, I think there's been a lot of influence from reading finance books. During the early stages, it was Peter Lynch, One Up on Wall Street. That was a wonderful book.
Right, it is a wonderful book.
That took me and got me into the depths of the market. And later on, I understood the philosophy of Warren Buffett, which was again something that quality is paramount when selecting a business. And ever since that, I've been working on what works, what doesn't work, asking questions to myself.
Right.
It's more of an introspection. External influences and books can take you only that far.
That's
but it's finally your own education and your own discipline.
Absolutely, absolutely. Over the years, sir, what has been your own allocation to assets other than equity, to debt, real estate, gold, etc.?
So the way I have planned my asset allocation is fairly simple, in the sense that the debt allocation is to meet my living needs. Should I choose to retire and I don't have an income stream, then my debt allocation should be adequate to meet my living needs. My real estate allocation is really not very big. It's just the house that I live in. And balance is primarily into equities. So I would say about 75% of my total assets is into equities.
Right. Sir, given the extremely hands-on nature of the job, how have you managed stress?
I think I've managed to live the moment, and the stress has really not showed on me, primarily because I take it as it comes. I do not anticipate problems. I handle problems as they come. And what I like about the job and my own personality is that I just cool off and close the books at the end of the day. And I promise this to my family, that I won't bring office work home. Though I do read a lot, and that I do at home, but I don't bring politics or stress back home to the home front, and that helps me de-stress.
Wow, that's a wonderful strategy to follow, I think. So, what has helped you create a reputation as a mid-cap fund manager, as a specialist in that segment, which is not so well researched?
I think one of the things that I understood about mid caps is that you need to be extremely patient, and there is no compromise on quality or the type of management that you're dealing with. So that's something which you factor in when you select the stocks. And I've been lucky many times also. I think that's one of the big things that helped me perform. But more importantly is to understand and be humble enough to accept your mistakes and move on. And I think that's been one of the learnings of being a mid-cap fund manager, that you can't get all of them right. There are some companies that are able to grow, some companies in the same business that are not able to grow. And to know the difference between the both is the most important thing.
So, you've been both on the sell side as well as on the buy side. What has excited you more?
I think buy side is more exciting in terms of the breadth and of coverage and the dynamics that take place between sectors, between stocks, between businesses. That's something which is exciting. But working on a deal, working on the sell side makes you understand a business far greater and in greater depth. And I think you need a mix of both. I would be partial to the buy side than to the sell side. But I think sell side has given me great discipline, the ability to communicate, and the ability to get in deep into a business.
Sir, in our past conversations, you've always said that you've been an analyst first and then a fund manager, or you are an analyst first and then a fund manager. Why do you think that is required in a fund manager?
So the basic aspect of a fund manager is that he buys and carries the stock till its completion of the price journey, or the fact that the business comes in as anticipated. As an analyst, what I've learned is that you need to anticipate change, you need to anticipate cycles, you need to anticipate growth, and when you make your financial projections as an analyst, what you actually do is that you look at various scenarios. So that prepares you as a fund manager to anticipate several scenarios that work out. It's never a singular outcome that you look at. And that has helped me to anticipate change and the dynamics in business and the dynamics in share price because of the changes in the underlying business.
Well, that's a very interesting insight. So, we've known, or we've always seen the way things have worked out in your portfolio. Could you also tell us a bit about some mistakes that you made in your early days or later in your career that you've learned from?
I think the mistakes of omission have been great. Sometimes what happens is that you look at a stock which has gone up, which is at a high valuation, and continues to remain so for well over a decade. And you have missed out all the compounding of returns that takes place. So traditional metrics of valuation sometimes doesn't work, and you need to keep an openness in these kind of things. And I think the basic learning of all this journey is that you cannot compromise on quality of management and the earnings growth. And that's the reason why we built the geek philosophy of growth in earnings and earnings quality. And that, along with being flexible on the valuation front to some extent, and not using a mathematical formula necessarily to derive at a value and stick rigidly with it, but rather go with the flow on the market side. That's been the key learning from some of the mistakes that I've made.
Let's move to your investment process now. Sir, how do you define your investment philosophy, and how has it evolved over the years?
I think I've been fairly uncompromising on the quality side, and I believe this quality takes two aspects. One is the earnings quality, as in it has to deliver and transform into cash flows. The second is the management quality, and I think the intent of the management is far more important than what they deliver in the short term. And that's where I feel that I would like to spend more time henceforth on understanding whether the management is got the right intent and is competent and capable of delivering sustainable growth. And we've seen several examples in corporate India where managements with focus, right intent, and right growth have delivered superior returns for decades in the same business. I think that's been the key learning for me, and I would think that henceforth I would like to incorporate that more into my portfolio and the style of management rather than just looking at it in a narrower sense.
So, when you zero down on an idea, from that point to the point that it becomes part of your portfolio, what is the process involved? How does it evolve?
So, we typically run a funnel in our portfolio management process. And what happens is we monitor the stock well before it even becomes part of our choice set. And we look at the stock for its earnings growth, whether it has kept up to its promises, lived up to expectations, and what are the key variables in the stock and its earnings. And once it kind of matures from the funnel, then we consider it in our choice set. And if we are convinced after a management visit or management interaction, then we push it into the portfolio. And what we do in our portfolio management process is that we allow stocks to earn their place. So it starts with a small allocation, and then we do a process of careful monitoring, and we then take it up, as in we reallocate capital from other stocks and push it into this stock if we are convinced that this indeed deserves it. Otherwise, we are happy to cull it after a period of 6 to 9 months if it doesn't deliver or keep up to its expectations.
So that was a bit about how a stock gets, included in your portfolio. Could you also give us a sense of your sell discipline?
So my sell discipline is driven on two things. One is absolute valuation relative to the market, absolute valuation relative to peers, and also understanding whether there's a better opportunity. Right. So luckily in the mutual fund side, you are never short of ideas, you're short of money most of the time. So the sell discipline pretty much happens automatically because you understand what stock is hurting your performance or no longer contributing to your performance, and whether the newer idea is actually helping you to get that bit of extra performance. So capital reallocation pretty much happens automatically, where you start culling underperforming stocks in favor of outperforming stocks.
Right. So from the conversation, it seems like it's a very hands-on job you're involved day in and day out. How do you unwind?
So weekends are meant for catching up on sleep. I pretty much love my sleep, and I enjoy my siesta as well. So I take my siesta and my break, and sometimes I love to read a novel. I like to read some John Grisham or something of that sort, and defocus from what I'm doing currently, and that helps me bring back the focus as well. So it's a little bit of that which I do from time to time, and otherwise I like to keep reading stuff like newspapers or magazines or articles, or even other things like travel logs, things of that
Wonderful.
sort.
From investigating stocks to investigating stories, that's a wonderful way to unwind. So we've been talking about your current process and how you evaluate stock ideas, etc. Let's look a bit into the future. How do you see the asset management industry in India evolving over the next, say, 5 years?
I think the asset management industry is at the cusp of a multi-year growth, primarily because our per capita income at $2,300 just covers the basics. And as the income levels rise, we are going to see savings increase and consumption also increase, paradoxical as it may seem, because as we cross the hump of our basic living expenditure, people will start indulging and saving. And therefore, I think the savings industry, of which the mutual fund is an important part, will continue to grow
Right.
and surprise for many years to come.
Also, sir, going forward, do you see the large cap category becoming more of a passive dominated category, or where do you see the active versus passive divide there?
I think the strategies will be different for across cap curves. Mid cap has been more of a buy and hold, whereas the large cap has seen little more trading coming in, primarily because they are well researched and the market movements are that much sharper in a large cap when there's underperformance or outperformance.
Right.
And also large caps have been the primary recipient of FII flows. And going ahead, we think that the difference of large cap and mid cap in terms of performance will also converge, as it has done over number of cycles. Now, you may want to ask whether it's passive versus active for large caps. And I think there's a role for everyone, and actives have a role of probably being more asset allocation or stock allocation, stock specific
Right.
allocation, whereas passives is buying the index. And if an investor wants to just buy the index and it is more of an asset allocation strategy for the investor, then ETFs may be the way to go. But if someone wants to create a little bit of alpha, then actives are the way to go. Let me also tell you that ETFs cap your upside to the asset returns, whereas there is a possibility that an active fund manager actually outperforms and generates alpha. You are curbing that alpha generation potential when you buy into passive funds. So it's different strokes for different people, and I think that I'll leave it at that.
Right. And as a final thought, sir, what is your message to budding fund managers?
So read a lot and introspect, because the only way that you actually improve on yourself is by asking questions as to what went right, what went wrong, and how you could do it better and improve on yourself. And the competition is no one but yourself, and that's the way to go ahead and learn and improve on your performance.
Great. It was a pleasure speaking with you, sir. Thank you so much.
Thank you, Akansha, for this opportunity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.